Thanks.
Just click the green to move forward.
Yep.
Good. Good morning, everybody. I'm Turner Holm, head of research in Clarksons Securities, investment banking arm of Clarksons PLC, the world's largest shipbroker and provider of commercial data research software. So, it's marine money. Let's talk about how to make some money in the marine segment. So I'm following on the heels of my friend and mentor, Eric Helberg, who did Marine Money in New York in June of 2022. And with his usual enthusiasm, got up there and screamed, I think he did scream, buy tankers. And that turned out to be quite a good trade. I think if you had bought at the time that Eric said, it would have been about double your money. So tough act to follow, no guarantees. But we're going to talk about dry bulk this morning, which I think I'll answer the question and say we think it is the best trade of 2023. So, the starting point, of course, is in shipping. It's all about the supply side, right? Demand is always unpredictable. You really don't know, right? I mean, at the end of the day, you really don't know. But what you do know about is the supply side. Unfortunately, my graph is getting a little bit cut off there. I don't know if we can move the window. Yeah, very good. So, the optionality here is fantastic when you look at the order book, right? I mean, in a historical perspective. So we're now moving to record low levels of fleet growth. If you take a look at the order book, it's the lowest as a percentage of the fleet since 1991. There's probably a few people in the room here that weren't born then. And then if you look at net fleet growth, right, net of scrapping, then we're at the lowest level since, I believe, 2003. Matching that. So it's really record levels of low fleet growth. And I think it's also very unlikely that we see any new orders anytime soon. Just looking at the structure of asset values, it's much more profitable to buy, makes more economic sense, you can say, to buy secondhand ships. Nobody's ordering new. And even if you did, it's mid-2025. So even if the market starts to recover, we're looking at probably 2026 before we start to get into fleet growth, right? And, looking at the years ahead, the net fleet growth keeps getting smaller. It's 2%, 1% in 2025. So while, I think a lot of people will look at dry bulk now and look at the low rates and say that it's challenged and China has a, property bubble they have to deal with. I mean, what do you really have to believe in, right? That's the question. What is the optionality in this trade, right? No trade is a guarantee, but the optionality is what makes this the best trade of 2023, we think. So on the supply, so we talked about supply side, and it almost couldn't look better. I mean, obviously tankers, we see similar dynamics, but on the demand side, we have some unique driving factors here. I think we in the West represent most of us in this event today. We're dealing with inflation, and we're seeing job cuts and interest rate increases, and the economic environment just feels very challenging, right? And dry bulk is extremely economically sensitive. But I guess also, as everyone knows, it's easy to forget like how important China is, right? So it's 40% of volumes and 50% of ton miles in dry bulk. China alone can drive the market. China has been in a recession for the last couple of years, right? We've had periods where 600 million people were locked down in their homes. And guess what? They're all coming out. And right now, this week, they're partying. They're having a great time. And when the party's over, they're going to get back to work. And they're going to spend money like we haven't seen in years. And what is that going to mean? That's going to be more demand for dry bulk, right? Like, they're coming out of a very deep recession. This is the economic cycle that matters. Forget about what's happening in the UK, in the US. It doesn't matter. It just doesn't matter, right? What matters is China. That is the driver here. And we are at a turning point in their economic cycle. And the Chinese dragon is about to be unleashed, right? So I think, you ignore that at your own expense. Of course, remember, you don't believe me? Okay, well, remember that the fleet growth is almost nothing, right? It's 2% this year, moving towards 1% over the next couple of years, and no one's ordering. So you really don't have to believe that much, right? So iron ore, that's clearly, the big China dominant trade. We see iron ore just about flat this year in 2023, although I think that there's upside given the stimulus measures that we see coming out of China. It's very clear that, with a domestic population that hasn't necessarily been thrilled with the zero COVID policy, that they want to, deliver on the social contract that they have with their people, which is deliver economic growth, right? And so they're going to do what they can, I think, to stimulate the property market and get the economy going again. I mean, we see very clear signs of that. Now, iron ore is also supply side driven. Tight labor markets in Australia, just difficult access to people to get iron ore supply up. Obviously, Brazil is still struggling in its own ways. But, we think the demand is there, right? Iron ore prices at 120, over 120. What does that tell you about the demand for iron ore? Yes, there's some supply side restrictions, but iron ore prices at 120, right? There's a demand for iron ore. If the miners can get it out of the ground, they're going to sell it. And steel prices, steel margins have been rising. So the other thing is coal, right? This is the second largest. Clearly, we're still dealing with an energy crisis here in Europe, so we're going to have to be importing coal, and we're not getting it from Russia anymore. 60% of our coal used to come from Russia. That's not the case in 2023. So we're coming from longer distances, from Colombia, from South Africa, from Australia, from the US, et cetera. So that's a ton-mile driver. In China, obviously, that's going to impact the coal market as well. Last week, I think that they've relaxed their emissions targets for 2023, which is another sign of their willingness to do whatever it takes in order to get economic growth going. So we think that coal is going to be a positive driver. It's a couple percent. Grain, which is the third largest, we're very excited about. We think that that's going to see quite strong growth in 2023. Again, it's a bit of a war story. The short haul exports out of the Black Sea have been limited by the security situation there, by the war. High prices have led to a lot of planting. We think there's going to be more exports out of Brazil, Argentina, the US, et cetera, and longer ton miles because you're replacing short haul ton miles out of the Black Sea to the Middle East with longer haul ton miles out of North and South America in many cases. So, you have little to no fleet growth, 2% this year, moving towards 1%. You have China reawakening. You have iron ore price very high, right? You have coal, which is, price has come down, but it's still very high, right? And we have an energy crisis in Europe. And we have grain, we have this trade pattern shifts. Like everything is really moving in dry bulk's favor when we look out on the horizon. But, right, when you're buying stocks, it's like, well, you gotta look at the price. You gotta look at the price. Is it a good price? Maybe a good product, but it may not be a good price, right? I like Swiss watches. They're great products, but I'm not buying them every day because they're expensive, right? But the stocks in dry bulk, they're still cheap, right? So on the left-hand side, you see the historical pricing versus NAV with dry bulk stocks. And they've come up from the bottom, but we're still below 1 times NAV on average for dry bulk stocks. So I think it would be a struggle to call the group expensive. And then, of course, we think that the asset values have a ways to go. Refer to the graph on the right, if you could just move thanks. So on the right, we see the new build parity curve. So that's just a replacement cost, right? It's the values relative to replacement cost. So the dark blue curve is your new build parity for secondhand Capesize. And we're still at big discounts. Right? So if you look at the asset values, they're pricing in about $15,000 a day, essentially, is what they're doing. Okay? $15,000 a day on a Cape. The long-term average is 30. Yeah? So the pricing is still very reasonable. We think that there's a lot of upside to the secondhand values, given the low rates that are being priced in today. And we've seen similar phenomenon play out, right? We saw it in containers, we saw it in tankers. We think, it's very possible that the same thing happens here in dry bulk, especially, again, given the low order book, right? So the equity pricing is not anticipating the upside potential in the asset values. And in fact, it's still trading slightly below 1 times NAV on today's very low asset values relative to replacement costs. So again, it's about, what can you do in this trade? Can you make money? What happens if things, go well, go as, we hope and think that they will. So what we do is one way to look at that, well, actually, I'll come back to that. First thing I'll say is risk. What's the risk? Well, in a shipping company, it's always the balance sheet, right? That's where you start. And the good news here is that the balance sheets for these companies are actually really good. They're actually really good. And some of them are pretty amazing. I mean, look at Ginkgo, 15% loan to value. It's nothing. There's nothing on the horizon that is going to ruin that balance sheet, right? And most of the group is at 50% or below, at very low asset values, right? At asset values which are at massive discounts to replacement costs. So keep that in the context, right? These companies are not going out of business tomorrow. Your risk on the equity is quite limited by the fact that the balance sheets are quite good, yeah? So that's obviously important to keep in mind. Looking to the right, and I'll come back to the left-hand side. Yeah, sorry. Thanks, Kevin. So I get a little excited. I like this trade. And you get paid to own the names, right? So these are our dividend yield estimates. 2023 in the dark blue for the group. Light blue is 2024. It's pretty decent, yeah? I mean, obviously we have higher interest rates today, and you have to have a higher dividend yield, et cetera. But 2020 bulkers, you can sit and wait for the market to turn and get 12% dividend yield. It's not bad, right? It's not bad. And 2024, as the market goes from $15,000 today, we estimate $20,000 today. And those are still very low rates. Remember, long-term historical average is 30. It's 18% yield. It's pretty good. And then, look, if the market really recovers, and goes back to sort of more normalized rates, and we get asset values which go up towards to new build parity, just replacement cost, essentially, then on the left-hand side, you see these blue bars. That's what happens if we go to 1 times NAV, right? If we go to 1 times NAV on what our NAV is based on our rate forecasts for the next 2 years on the 2024, right? So, it depends on the name. It ranges from 30 to 113%. And this is at new build parity. Remember, as tankers and containers really took off, I'm not saying that's going to happen here, but those have gone over NAV, over new build parity, and traded in NAV. So I think this is a realistic way to look at what the upside potential is here, right? From 30 to 113%, depending on the name that you're looking at. But many of them 40, 50, 60, 70%. I think that's a quite decent upside given the limited risk that you have with the low order book and the strong balance sheets. Thank you very much.